Hey everyone, and welcome to Talk ETFs. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, we're talking with Rich Lee, who is the head of program and ETF trading at RW Baird. Rich, welcome to the show.
Thanks for having me today.
Absolutely. So one thing I've been hearing a lot about is how the stock market has been rallying, yet the market is top heavy. Most of the gains have been coming from a handful of stocks. Is that true? And if so, is that concerning to you?
Certainly, and that's something that a lot of market participants have been looking at, right? Certainly the concentration, if we're going to take, say, the S&P 500, for example, right? That there's a large concentration of mega cap stocks that seem to be dominating the index, right? And in some ways, like, concentration is part of the point, right? The S&P is a market cap weighted index. So by virtue of the market caps getting bigger, it will naturally become a larger percentage of the index. Now, if the question is, is it a concern that you're not getting proper diversification because, for instance, the top 5 stocks in the S&P 500 happen to be tech stocks, right? And maybe you're not getting sector exposure, maybe you're not getting volatility exposure or some other exposure, then it might be something that you want to think about. So, if you think about like the S&P 500, its performance, it's up 12.36% year to date, and the top 5 names represent 21% of it, right? So it is certainly a consideration, but again, you have to kind of think about like what your goals are. Are you looking to diversify, or are you looking to get replication across, say, the market of the 500 largest stocks in the marketplace, in which case products like the S&P 500 and Spiders are doing that.
And obviously it is market cap weighted, so the biggest stocks are going to have the biggest weights. But I did see some interesting stats about how Apple and Microsoft, the 2 biggest names in the index, make up some really high number, 15% or something. And that's the most ever for 2 stocks in the index. So it definitely seems like we haven't seen concentration like this in a really long time.
Sure. And we've been tracking it as well. And I think I ran some numbers about a month and a half ago. And even in that time, like Apple and the 2 largest names have added another 1.6% to the index, so that growth is continuing to increase a little bit.
So what does it mean for ETF investors? Obviously, the default is to buy something like the S&P 500 or a total stock market index, but we do have ETFs that target small caps and equal weighted ETFs where everything in the S&P 500, for example, is weighted the same. Are these things that investors should consider?
Again, I think it comes back to sort of what the investment objectives are, right, of the investors. And I think you raise a really interesting point, right? As the weights of the top 5 names and, say, things like the S&P 500 have continued to grow, people have become increasingly aware of the potential lack of diversification from a sector perspective, from either dividend perspective or what have you. And so I think that opens up the opportunity for people to look at other products out there, right? Maybe it's a specialty in underloved small and mid-cap stocks. Maybe it's an opportunity to look for yield or inflation stocks that may speak to the inflation environment that we're in. So as an example of that, if you look at sort of the RSP, which is the equal weight S&P product, right, that had record inflows in excess of $1 billion last week. So people and investors are certainly starting to think about diversification away from market cap weighted indices or maybe even large tech stocks, right? So we're starting to see that play out a little bit.
So what other trends are you seeing in the markets, Rich? I know that active ETFs have been a big story when it comes to ETFs. Are we seeing anything noteworthy there? And what other trends are catching your eye?
So I think related to this theme about what investors are becoming increasingly cognizant of, right? Diversification from large cap passive indices or products like the S&P. Where can I look for additional yield, right? And that, I think that opens up an opportunity for some of the active stocks out there, and even the thematic stocks, right? So thematic, but like with a goal, right? So if you think about the macroeconomic environment that we've been in the last year, right? Are there products that speak to fighting inflation? Are there products that speak to the search for yield? Or maybe investors are looking for low vol products, right? So take an example and look at the popularity of JP Morgan's JEPI ETF, right? That is a premium income ETF, and you basically just had Goldman Sachs filing for issuance of 2 similar products. So clearly there's a demand for these type of products that speak to investors looking to solve specific problems that they see as a result of some of the issues we're seeing in the macroeconomic environment out there.
Speaking of thematic ETFs, one of the hottest themes of the year is, of course, artificial intelligence, the buzzword of the year. What's your take on AI ETFs?
I think AI is definitely an area of interest. I think AI as an industry is going to be transformative. One thing that I would say to keep in mind, though, it's sort of that old truism, right? Which is people tend to overestimate the impact of technology in the short run and underestimate it in the long run, right? So, I think we're in the very early innings of the AI game, especially as it relates to how it's going to transform business and business processes. So, with regard to AI ETFs, I think there's actually very few pure play ETFs that are geared towards AI out there, right? There are ETFs that speak to AI. There are ETFs that have exposure to AI. But in terms of getting that distilled exposure, there aren't that many out there, right? So, for instance, if you look at some of the AI-based ETFs out there, right, they're tech companies that have AI exposure, right? Things like ChatGPT at Microsoft, things like Bard for Google. But you're also getting the exposure that's inherent in owning those stocks that may not be isolated to just a pure play AI investment, if that's what you're looking for. So I think it's definitely an area of interest and an area to watch.
Finally, Rich, we don't talk a lot about financial market infrastructure here at ETF.com, but as I understand it, we're going to see some big changes when it comes to the settlement of securities starting in 2024. Can you tell us about that?
Sure. So we exist in a global marketplace, right? And currently, for most developed markets, settlement is aligned on a T+2 settlement cycle. And that makes it easier for if you're doing something such as a global rebalance, where you might be raising cash in Europe and Asia and then funding buys in, say, the US, right? It's also a consideration when you're doing create redeems for global ETFs, where you have to align settlement cycles for European and Asian stocks as well as US stocks. If we don't have alignment, there is going to be settlement mismatch, right, between Europe and Asia, which is predominantly developed markets, have a T+2 settlement cycle, when we in the US move to a T+1 settlement cycle next May. And that raises all sorts of potential issues, right? There's potential for settlement mismatch. There's potential where you're going to have issues with settlement efficacy and not matching on trades. For instance, if a European manager does a trade in the US, by the time the US market closes, it's 10 p.m. in Europe, right? So how do you match and affirm trades on that basis? And additionally, you have this issue where cash becomes an issue. In a non-zero interest rate environment, use of cash and cash proceeds to potentially fund settlement mismatches are going to become an issue. And if you think about ETFs, they tend to have low management fees, right? Especially some of the more passively tracked products. So you're going to have to think about how you manage your workflow to mitigate some of these risks that are inherent, as well as how you're going to most efficiently utilize cash in your portfolio, given that you want to maintain those tight and lower expense ratios inherent in ETFs. So I think these are things that managers need to think about as we start to approach a T+1 settlement cycle.
Well, we're going to have to leave it there. Rich, a ton of great information. Thanks so much for taking the time and speaking with us.
Thanks for your time. Have a good day.